Do you know what the biggest misunderstanding about recessions is? Everyone thinks they're disasters that cause wealth collapses. They panic, sell everything they have, and hide under the covers until the storm passes. But the reality is exactly the opposite. Recessions don't destroy wealth, they just transfer it from the unprepared to the prepared, from the emotional to the rational, from those who panic to those who plan. In my career spanning over 40 years, I've witnessed 8 recessions. The double recession of the 1980s, the 1990-91 downturn, the 2001 dot-com crash, the 2008-2009 financial crisis, the 2020 pandemic recession that struck like lightning and hit everyone, and several other smaller contraction periods. In each of these, while most people experienced losses, some people were multiplying their wealth. The difference wasn't luck or timing, it was preparation and recognizing which assets truly grow when the economy goes through a tight process. Many people view recessions as periods when everything completely collapses. Stock prices hit rock bottom, real estate values tumble down the cliff, companies go bankrupt, unemployment peaks, and each of these is true. But there's something that gets overlooked. While some assets are going down, others are rising. While some businesses sink to the bottom, others are exploding. While some people struggle, others are capitalizing and profiting from opportunities that only emerge during periods of economic stress. At J.P. Morgan Chase, we made our best profits during recessions, not despite the recession, but precisely because of it. In the 2008 crisis, we acquired Bear Stearns by paying $2 per share, and it was $170 a year before that. We caught Washington Mutual's assets for $1.9 billion when they were worth tens of billions. We expanded our market share to wider networks, added strength to the power of our competitive position, and took positions for the recovery process that we knew would eventually happen. The next recession is at the door. It always knocks because economic cycles are as predictable as seasonal transitions. Contraction periods follow expansion periods step by step. Fear periods merely watch over periods of optimism. Tight money periods chase after easy money periods. The questions are, at what time and how high is its intensity? When I observe the cycle point we're at, inflation has risen quite a bit. Interest rates are climbing again. Debt levels are racing from record to record. Geopolitical tensions are rising. For the next recession, I'd say this isn't a matter of if, but when. I want to tell you about 4 specific asset classes that not only manage to stay standing during recessions, but truly grow wealthy. These concepts aren't theoretical. Assets that have beaten the market in every major recession experienced in the last 50 years. Assets that provide significant upward return opportunities while everyone is losing money, and assets that provide protection from downward collapse risk. The first asset class is safe haven assets, but not the well-known ones everyone talks about. Yes, government bonds and treasury bills do well in recessions. Investors start running to the safe side. Interest rates are pulled down. But the real opportunity is in high-quality corporate bonds from companies with strong balance sheets that have fallen to distressed prices due to credit market panic. Credit markets freeze in every recession period. Investors become terrified of any credit risk, even from fundamentally sound companies. This creates incredible opportunities for you to acquire bonds from companies like Apple, Microsoft, Johnson & Johnson, companies that have no chance of failing even in a quite serious recession, at yields that are impossible to obtain in normal economic conditions and periods. If I were to give you a specific example, I need to talk about the 2008 financial crisis. Toward the end of 2008, when credit markets were in a completely frozen state, you could obtain Warren Buffett's Berkshire Hathaway bonds at yields above something like 8%. Berkshire Hathaway, one of the world's strongest balance sheet with over $100 billion in cash, was paying 8% because credit markets had completely collapsed. Those bonds not only provided that 8% income, but their values increased significantly as credit markets returned to normal. Many high-quality companies realized this pattern. McDonald's bonds were yielding 7%. Coca-Cola bonds were yielding 6%. These companies weren't distressed companies. They were several of the world's strongest franchises, but their bonds were priced as if they were going to collapse because investors had almost completely lost their appetite for credit risk. The pattern repeated in the 2020 pandemic recession. recession. During March 2020, when markets hit bottom, high-quality corporate bonds were sold in a dramatized manner. Even though many of the underlying companies had excellent financial conditions, healthcare companies, technology companies, basic consumer goods companies, their bonds were trading at yields that hadn't been seen in years, creating mind-boggling opportunities for investors who had the cash power and purchasing courage when most were selling. Focusing on quality was the most critical point. Credit quality is very important during a recession. You want bonds from companies with low debt ratios, generating strong cash flows, offering essential products or services, and having the financial mentality to weather a prolonged downturn. Stay away from anything speculative or highly leveraged. This isn't the time to chase yields. This is the time to focus primarily on safety and benefit from the fact that high-quality credit is trading at distressed prices. The second asset class is what I call crisis opportunity companies. These are businesses that truly manage to benefit from economic downturns, either because their business models are naturally recession-resistant or because they gain market share while competitors struggle. Discount retailers are classic recession winners. During the 2008 financial crisis, while the retail sector struggled, Walmart's stock rose 20%. Dollar General experienced a 25% value increase. Costco left the market behind by a significant and noticeable margin. The reason was that when consumers were under financial pressure, they turned to lower-priced and efficient alternatives. Instead of shopping at department stores, discount stores were preferred. Branded products surrendered their place to generic brands. They focus on value rather than luxury. This pattern was consistent across multiple recessions. In the recession at the beginning of the 1990s, Walmart expanded rapidly while other retailers retreated. In the 2001 recession, discount retailers once again took the lead. In the 2020 pandemic, while traditional retailers struggled, essential retailers like Amazon, Walmart, and Target saw massive growth. Another crisis opportunity company category is what I call repair businesses, bankruptcy lawyers, debt collection agencies, restructuring consultants, distressed asset buyers. As more companies and individuals need these services, these businesses experience significant and noticeable spikes in their revenues during recession periods. In the 2008 crisis, debt collection companies saw their stock prices increase as credit defaults rose. Bankruptcy law firms experienced 2 to 3 times increases in their revenues. Distressed asset funds gained record amounts of capital. Although controversial, pawn shops and payday lenders are another category that sees increasing demand during recessions as people need quick cash access. Gun manufacturers generally see increased sales during periods of social and economic uncertainty. Home security companies benefit from crime rates that multiply during economic downturns. At the institutional level, companies that buy distressed assets can generate tremendous returns. During the 2008 crisis, private equity firms and hedge funds specialized in distressed investing made fortunes by purchasing assets that banks and companies were forced to sell at fire sale prices. Real estate investors in cash positions were able to acquire properties at 30 to 50% discounts compared to their peak values. The key point with crisis opportunity companies is properly understanding the specific recession dynamics that drive their business models. Some benefit and profit from consumers turning to cheaper options, others from multiplying financial distress, still others from the general uncertainty and disruption situation that recessions have created. The important thing is this: being able to identify these opportunities before the recession hits, while stocks are still trading at normal valuations. The third asset class is defensive infrastructure investments that generate stable cash flows largely independent of economic conditions. These are assets that both individuals and businesses need to use whether the economy is strong or weak, and they typically have pricing power that allows them to maintain or even increase their revenues during downturn periods. Public utilities are a classic example. Whether the economy is in recession or not, people need services like electricity, water, gas, and telecommunications. These are essential services that absolutely cannot be postponed or canceled. In the 2008 financial crisis, while the S&P 500 lost over 50% of its value, utility stocks only declined around 20%. During the 2020 pandemic, while many sectors showed negative performance, the utilities sector was able to produce positive returns. downturns. But I'm not just talking about traditional public utilities, I'm talking about more. For instance, during recessions, cell phone towers provide critical infrastructure that becomes more important, not less. During the 2020 pandemic, as many people worked from home and relied more on digital communication, tower companies saw increasing demand and rising revenues. Crown Castle, American Tower, and SBA Communications all left the market significantly behind. Data centers are another example of defensive infrastructure. As the economy continues to digitalize, data storage and processing become more essential during recessions. Companies can cut their spending on travel or marketing, but they cannot terminate the spending that occurs for the digital infrastructure their businesses depend on. In both the 2008 and 2020 recessions, data center companies continue to increase their revenues without experiencing a noticeable deterioration in demand. Toll roads and airports were interesting cases because they combine essential infrastructure with recession sensitivity. People still need to travel, yes, but they do it less during recessions. Most of these assets are structured as monopolies or near monopolies, with regulated tariff increases, able to maintain pricing power even when volumes fall back. The best airport and qualified toll road companies actually emerge stronger from recessions because they use the downturn to invest in improvements that multiply their competitive advantages and opportunities. Especially self-storage facilities offer a defensive infrastructure that's relatively independent of economic cycles. During recession periods, people are downsizing their households, but still need places to preserve the belongings they own. During economic contraction, while businesses consolidate their office spaces, they continue to turn to storage for their physical assets. During economic stress, divorce rates multiply, creating temporary storage demand. Self-storage companies see that occupancy rates can generally be maintained and even increase during recessions. In the context of defensive infrastructure, the fundamental point is to turn to assets that provide essential services thanks to high entry barriers and noticeable pricing power. You want infrastructure that people and businesses not only choose to use, but also are forced to use. And you want infrastructure with monopolistic characteristics that can maintain or increase price levels thanks to market structure, even when demand conditions soften. The fourth and final asset class is precious metals and commodities. But the importance of these assets isn't limited to the reasons many individuals commonly think. Although these factors are important, it's not just inflation protection or currency devaluation alone. Specific supply and demand dynamics that generally favor commodities during recession periods and the processes that follow them. Gold is the obvious starting point. Gold historically shows stable and strong performance during recessions for several reasons. First, as economic uncertainty increases, investors flee risky assets and turn to safer havens. Second, it benefits from lower real interest rates as central banks lower nominal rates to fight the recession. Third, it benefits from currency devaluation as governments print more money and run high fiscal deficits to keep the economy alive. During the 2008 global financial crisis, while stocks lost over 50% of their value, gold largely moved sideways, revealing that it served a very effective protection function in portfolios. But more importantly than this, gold continued its climb for several more years after the recession ended, reaching all-time records above $1,900 per ounce, as investors worried about the long-term effects of the aggressive monetary and fiscal stimulus used to fight the crisis. In the 2020 pandemic, gold again succeeded in portfolio protection during the initial shockwave, and afterward continued its rise as the Federal Reserve pulled rates to zero and expanded its balance sheet by trillions of dollars. Gold recorded its new historical record by rising above the $2,000 level, with a multiplication of concerns about currency erosion and financial system instability. But gold isn't the only precious metal that benefits during recessions. During times of economic stress, the other metal that generally performs higher than gold is silver, because it has both monetary properties and industrial applications. During recessions, silver benefits from safe haven dynamics similar to gold, in line with investors' risk aversion tendency. But during recoveries, it benefits from increasing industrial demand as economic activity accelerates. Beyond precious metals, certain commodities can grow wealthy during during recessions due to supply irregularities or strategic considerations. Energy commodities, for example, often receive support from geopolitical instability that accompanies economic downturns. Agricultural commodities can receive support from adverse weather conditions, restricting production, or supply chain problems intensified by economic stress. But the truly defining dynamic regarding commodities during recessions emerges in the supply response that producers give to price declines. When prices fall, commodity producers sharply reduce investments in production, creating supply shortages for the recovery process. In this framework, mining companies shut down and disable high-cost mines. Oil companies suspend new drilling projects. Agricultural producers narrow their planting areas. This creates a structural foundation for commodity price increases when economic activity regains momentum. During the 2008 to 2009 recession, copper prices fell from over $4 per pound to below $1.50. But commodity producers responded by terminating high-cost production, and when economic activity began to regain momentum, copper prices experienced a rapid recovery, eventually reaching new all-time record levels above $4.50 per pound. A similar dynamic was observed in the oil market. Prices experienced a decline from over $140 per barrel to below $35, but afterward, the continuation of economic growth and producers not having sufficient capacity to meet increasing demand allowed oil to enter a strong recovery process. The focal point with commodities during recessions is understanding the specific supply and demand dynamics for each commodity. Some commodities show resilient performance during recessions thanks to their defensive characteristics. Others are crushed with sharp value losses during the downturn process, but prepare the ground for strong rises in the recovery phase. The fundamental issue is taking positions to benefit from these fluctuations, rather than being victims of these cycles. Now let me explain in a holistic framework how to build a recession-resistant portfolio that aims not only to protect capital, but truly grow it during the next downturn by considering these four asset classes. The most critical point is understanding that these asset classes create the highest impact when considered in combination rather than individually. Each provides different types of protection and different return opportunities. Safe haven assets provide stability and income during the chaos created by the downturn. They are your defensive foundation that allows you to remain calm and rational while everyone is panicking. High-quality corporate bonds trading at discounted levels due to temporary stress can offer both regular cash flow and capital appreciation potential as credit markets normalize. During the recession itself, crisis opportunity companies provide growth potential. While most businesses are floundering, these companies are actually benefiting from the economic downturn. This is where you can not only keep money alive, but earn more during the recession. Defensive infrastructure assets generate stable cash flows largely independent of economic balance. These assets help you maintain your income stream even when other dividend-paying stocks stop their payments. Moreover, they provide protection against inflation and generally tend to show stronger performance during the recovery. Precious metals and commodities generally provide protection against currency devaluation and fiscal irresponsibility experienced during recessions. In addition, they position you to benefit from the supply shortages and inflation that often follow downturns. Specific allocation depends on your risk tolerance, your investment horizon, and your other income sources. But a recession-resistant portfolio would look like this: 30% safe haven assets, including treasury securities and high-quality corporate bonds; 25% crisis opportunity companies, including discount retailers and distressed asset buyers; 25% defensive infrastructure, including utilities and essential service companies; and 20% precious metals and strategic commodities. This doesn't mean managing with a buy-and-hold approach forever. As economic conditions change, as recession knocks on doors, as recoveries progress, you need to adapt your portfolio to capture emerging opportunities. In the depths of the recession, you can hold more safe haven assets and turn to companies that will create opportunities during crisis periods. As recovery begins, you can shift toward defensive infrastructure and commodities. The truly important point is to start positioning yourself before the downturn arrives. When everyone agrees we're already in a recession, it's too late to catch the strongest positioning. You want to buy these assets while they're still at reasonable prices before the recession premium is added to their valuations. And remember, recessions create some of the best long-term investment opportunities you'll see. The companies and assets you buy during a recession period generally provide your highest returns to your portfolio over the following decade. This isn't just about preserving capital during the downturn. What matters is positioning yourself to grow wealthy during the recovery period and the next growth phase. The next downturn is coming. The question isn't whether you'll face it, but will you be prepared for its arrival or not? Will you be among the individuals who transfer wealth from those caught unprepared, or among those to whom wealth is transferred? The choice belongs to you, but you need to make this choice now, while these assets are still available at reasonable prices, and while you still have time to build a recession-resistant portfolio. Because when the recession hits, when markets crash, and when everyone is panicking, it will be too late to implement this strategy. You need to position these holdings before the storm arrives, so that when everyone is selling, you can buy, and when everyone is panicking, you can profit.